Tuesday, June 14th, 2022, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at how the markets are losing faith and confidence in the Federal Reserve and other central banks for that matter, and what repercussions that will have in the financial markets in terms of market risk, counterparty risk. That's a big risk coming now as well. Before I start though, I like to say that throughout the years, many of you have asked me where they should buy gold, how they can buy gold. I don't advise people to buy gold, but of course I talk a lot about gold and how important it is to have physical gold in the current environment, or any environment really, but especially now. And what I tell people is that they need to do their homework, look for the best deals out there, find a reputable dealer. But I also have a promo code and an affiliation with Gold Investments. They're a family-run business. They've been in business for 40 years in the city of London. And yes, they'll provide you a very personalized service. They do have a website, but you can also go there physically to their office to talk to Oliver or Simon. And yes, if you use my promo code Monaco64, they'll make sure that they'll match any other price in the UK from any other dealer, and they'll give you a small discount as well. So, Federal Reserve, yes, the markets are losing faith and confidence. And how can I say that like this? Well, because I worked in the financial markets as a bond, futures, and options broker for institutional clients, as I said the other day, for over 20 years. And I also worked in the cash market before I went into the futures market. And when I started out in Switzerland, we did all kinds of financial assets at the small bank I worked for. But our firm was mostly involved in bonds. So I know quite a bit about the bond market, maybe not as much as some other people, but I can tell you that what happened yesterday in the US Treasury market and other markets, other government bond markets, is pretty much unprecedented for me. I've never seen it move like this, except for March 2020, when we had huge volatility in Treasury yields. And why is that so important? Well, because US Treasuries are supposedly the safest assets in the world, right? We're told that's how they measure risk-free returns through US Treasuries. They're supposed to be as solid as gold, right? And to have them move how they did yesterday, the repercussions that has is, number one, a lot of financial institutions, and I know this from experience when I worked at MF Global, we had clients who kept Treasury notes or bonds as collateral for their trading. So when you have the collateral going up and down in value like a yo-yo, it's no good. That's why having cash is probably better. So why do they use Treasury as collateral? Well, because the brokers and the financial institutions accept them. And if they were to convert it to cash, they wouldn't be getting the return. So it's the greed and the leverage as well. A lot of times, of course, these banks will take $1 million worth of 10-year notes and give their clients $100 million of liquidity. So you can see how that results in all kinds of trouble, especially when what happened yesterday happens. If you can look here, I took a snapshot at the end of the day of the US Treasury yield curve, all the different securities. And except for the 1 month Treasury bill, which was up just over 2.5 basis points, which is fairly normal. All the other ones are up more. Almost all the other ones are up more than 20. Some of them are up 46 basis points. I mean, that's why the Fed is losing the plot, and the markets don't trust the Fed anymore. They have no idea what the Fed is going to do. Some people are saying they're going to raise by 50, or some even by 1 or 3/4. And we don't even know what they're going to be doing in a few months' time. And that's not good. And that's why on Friday as well, there were no bids for mortgage-backed securities, because people lose faith and confidence as well in other counterparties in the markets, because these people might be holding mortgage-backed security as collateral, or other corporate bonds, and even treasuries. So the way it works is a big, let's say, wealthy investor has an account with JP Morgan, and he wants to buy 500 million or do something in the market, and JP Morgan will call a dealer in that security, and the dealer, even with JP Morgan, they will be a little bit worried, and they'll say, well, the screen is showing 99.5 bid, but my bid is 97, and JP Morgan won't deal because it's too far down. That's basically a no bid, because people don't trust each other. That's the counterparty risk problem. It happened during the Lehman crisis, after Lehman collapsed. If there hadn't been a bailout and TARP and all that, all the other investment banks, JP Morgan, Goldman Sachs, all of them would have gone under. And I've been warning about counterparty risk, and I even have a playlist if you want to look into it. There's only 3 videos there, but I said in this video here, counterparty risk will dwarf market risk in the next financial crisis, and it did almost in 2020, and I think it will again this time. And switching over to the crypto space and what happened with Celsius Network. I don't know much about them, but I saw all the news yesterday. They froze accounts, they froze withdrawals of people's funds. They also froze or stopped people from transferring funds within the network. And that's counterparty risk. I mean, Celsius was acting just like a bank. And it's ironic because the crypto space is supposed to be a solution to this corrupt fiat currency fractional reserve banking system that we have. But they've actually created a system that's very similar. And I think Celsius is a canary in the coal mine for counterparty risk. So how do you avoid counterparty risk? Well, there's only one way. It's to have your savings outside the financial system. One way to do that, of course, is to buy physical assets, like this home that I'm in. There's no counterparty risk. I own it outright. Or an automobile, if you own it outright, or a classic wine, or a vintage wine, or a vintage car, things like that, or physical gold and silver, of course, not ETFs. Yes, there are counterparty risks when someone's holding it for you. And what does it mean it will dwarf market risk? Well, on Friday, there is no bid for mortgage-backed securities, so you don't even know the value of the assets. And when it gets to that point where people don't even know the value of financial assets, which was a little bit what happened, I would say, yesterday, or is just starting to happen with treasuries, counterparty risk becomes everything, because no one will want to deal with anyone in these financial assets. That's what it's all about. So the easiest way to show you what counterparty risk isn't is to show you an ounce of gold, because that will never change the value. It's always an ounce, and I'm holding it. How would I get counterparty risk with this? Well, if I gave it to Billy to look after it, Billy would be the counterparty risk, but I trust Billy more than probably any financial institution, of course. The same thing goes for silver. If you hold an ounce of silver, it's an ounce of silver. It's not going to change. So the prices that we see on the screen for gold and silver, they become irrelevant, in my opinion, unless, of course, you need to sell your physical for a dying currency. And even if you want to buy some of this and some gold, it's going to cost you a lot more right now. Someone sent me this. It's a good one. It says, I think it's got the Federal Reserve headquarters in Washington, and it says Den of Thieves. So that's very appropriate. So that's what counterparty risk is about. I think it's going to become more and more serious. And the other thing that affects counterparty risk and liquidity. Liquidity is another problem. In 2020, there was no market in treasuries. There's no liquidity. It's supposed to be the most liquid financial market in the world, and I think that's going to be another factor, because the volatility is off the charts, and market makers, the people who make a bid and an offer, they won't be there, and if they are, their bids and offers are going to be as wide as the QE2 ship. That's an old saying in the city of London. And you could drive a huge ship through it. But yes, that's where I think we are. And what can the central banks do now? Can they pivot and save the day? I'm not too sure about it. Yes, a lot of people are expecting them to pivot, but will it work this time? It could, if they throw everything at it, if they reverse a course very sharply and they start QE again. But right now, with prices rising as they are, with the CPI almost at double digits, and the Fed looking totally discredited, because remember last year they're saying it was transitory. Now everyone thinks it's speaking. What if CPI is at 12% by October? I mean, it's just crazy what's going on. So what about commodity stocks, miners? Yes, they got hit very hard, and believe me, I can see what my holdings did. And again, let's say if I weren't able to access those holdings, or something happened in the system, a breakdown of the whole financial system, it wouldn't hurt me financially, because I'm outside the system more than I'm in the system. Of course, it wouldn't be nice. So yesterday was a case of, they threw the baby out with the bathwater. So even commodities and miners didn't do well. But I expect in the longer term, of course, that nothing has changed. And we can see that through the performances of the financial assets this year. I mean, I don't know how much lower the TLT is now, but it's almost like 30% TLT is an ETF on long-term treasuries. We've got S&P now in the bear market, down 21.3% year to date. The NASDAQ is down almost 31%, and the Dow down 16%. Commodities, on the other hand, the Invesco Bloomberg Commodity ETF is up almost 33% year to date. Gold in dollars is pretty much unchanged year to date. I think 2021 we finished around 1820, but in other currencies, for example, in British pounds, we're up about 10% gold. Yes, silver slightly down, but not down as much as stocks and bonds. So that's the way I see things. So let's look at where the markets are this morning. And yep, so it's 8:45 a.m. London time. We've got spot gold at 1827. It's up about $7. Overnight high has been 1832. The low was 1808. Silver is up 22 cents or 1%, 21.30. High's been 40 and the low 20.98. Stock market has rebounded a little bit. Not much though. The Dow is up less than 1% or 250 points. NASDAQ is up 1.3%, 146 points. S&P 500 is up 40 points or 1%. FTSE is up 30 points. Eurostoxx 50 is up 22. To the currencies, yes, the dollar did very well against other fiat currencies. Keep in mind, though, that as I've said many times, the dollar and all the other fiat currencies are sinking, right, versus real things. So don't get distracted by the dollar index. Sterling right now is back up a little bit, up 0.5%, 121.86. I think we made a new low for the year yesterday, almost below 121. The euro is up 0.5% as well at 104.62. The dollar is unchanged versus the yen at 134.35. Yesterday afternoon, US time, JGB, the 10-year JGB yield broke through that limit that the BOJ has of 25 basis points. It went up to 30. That was understandable maybe because the BOJ was not in the markets at the time. I don't think they have an office in New York or London. So this morning, though, we're back at that 25 level. So the BOJ still has control of that 10-year yield. I don't know how much longer they'll be able to keep control of that. The dollar is down 0.2% versus the Swiss franc at 99.05. And the dollar is down 2/3 as well versus the yuan at 6.74. Russian ruble. So let's have a look here. The dollar's at 58.30. So the dollar strengthened a little bit against the ruble here this morning. Not that much though. Aussie dollar. Aussie dollar is up 0.5% as well, 69.54. And the dollar is down slightly versus the Canadian at 128.88. And last but not least, the Kiwi dollar is up 0.4 at 62.82. So it looks like the dollar has come off a little bit this morning and people are buying back stocks and bonds as well. We'll look at the 10-year yield in a moment. Before that, we'll look at the general commodities. WTI crude is up 0.6% at 119.30, so almost back up to 120. Brent crude is up 0.6 as well at 121.50. And high-grade copper is up 0.5% at 4.25. So yeah, the 10-year yield is down 8 basis points right now, and there's the volatility again. We're back at 3.29%. The 2-year, by the way, is down 2 basis points at 3.28. But there's some confusion yesterday whether the 2s, 10s had inverted, and I think it did briefly. By maybe a fraction of a basis point. So that's the other thing people are looking at. If the 2-year yield goes above the 10, that's a bad sign for the economy. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And yes, I wish you all a great day. Take care. Bye.